A warm welcome to you all for joining us on this special webinar series, Getting Ready for Tax Time. As a few of you might be familiar, we are a small not-for-profit organisation called 10thousandgirl, and our purpose is to improve the financial well-being of Australian women and families across the country. And we do this to, our aim through, I suppose, making finance really social and fun. So we've actually set out a few years ago to reach 10,000 women, and we've done that now, but we're continuing on our mission, and our sort of flagship program is what we call our 6-step money makeover. So I'll talk you through this and show you sort of where the information that we're talking about today fits in to what is really important to understand a broader context when it comes to ensuring financial well-being in your life. So the process we generally guide people through, whether it's in our, sort of 6-step money makeover program, which the next round starts on the 20th of June, or whether it's just helping you guide through some of the DIY resources on the website, we always encourage people to start with making sure you've got clear life goals. The reason for this is if we don't know what we want to achieve in our lives, and we don't know the key things that we want to do and have in our lives through different phases, it's very hard to work backwards and see clearly what financial resources you need to have in order to achieve those goals. And Bernie, our accountant today, would agree that it's so much easier, even when you're seeking advice, if someone's really clear on their goals, then their tax affairs, etc., can be structured in a way that suits your aspirations and timeframes, etc. Then step 2 is all about taking control and having a real sense of awareness around where you currently stand. So whether it's where your income's coming from, where your expenses are going, whether it's having a really good money system, so every time money hits your hands, it's being used as effectively as possible. So you've got the best interest rates, you've got a clever system set up where you're automatically saving or paying off debt, or making sure that your system's efficient. Then, of course, understanding debt, and we'll talk about that in a webinar that's coming up also, because it's such a key part, understanding, what is good debt, what's bad debt, and what's really ugly debt, and how do we get rid of it if we do have it. And then, of course, having emergency buffers and insurance in place. So when you do start investing and when your strategy does come a little bit more complex, you've got those really strong foundations laid before you start taking any financial risks. And then step 3 and 4 is really about understanding some of those investing principles and making sure that we understand the different behaviours when it comes to putting our money in cash or in property or in shares or in our own business, and some of the ways you can reduce risk or assess risk when making those investing decisions. Then, of course, long term and throughout our lives, we want to make sure we're maximising super. We want to have a handle on our tax affairs and make sure that we're doing the smartest thing to minimise our tax, but making sure we're doing it in a kosher way. So that's what we're going to talk about more this session. And then, of course, about estate planning, and that's really about caring for others around you, your family and people you will either leave behind or want to leave a bit of a legacy too. So, and then step 6 is all about building your professional support network. So we'll talk a bit more about this this session, about the importance of getting good advice and how that can actually save you money over time, but what you can do yourself to make sure that those conversations are engaging and efficient, and any costs associated with getting advice are minimised because you are really organised and can ask really great questions and maximise that advice that's being given. So everyone who goes through that 6-step program donates, contributes to some microloans, and there's more information about that on our website. But it's all about, as we each increase our capacity to, economically sort of enable our lives, we make this huge ripple effect, not only in our own lives and our families' lives, but we really have our positive steps now can make global contributions. So that's a really exciting part of the program. This webinar series is free because we have these wonderful partners on board. Financial Literacy Australia and Rabobank have been working with us in a 2-year program to really make sure that we reach regional women especially, but women from all walks of life all across Australia. And we also work with the Financial Planning Association and HESTA, the Insurance Council of Australia and Credit Savvy, and the ATO, who have really helped with this webinar and who have given us a heap of great resources to send you along with the recording after the webinar. So a huge thank you to Bernie, who joins us as our special guest today. Bernie is one of those accountants that can actually explain things in real life language. And I have to say that tax is probably my least favorite topic out of all the sort of financial elements. And to a point of, I would have to be inclined to say it irks me and stresses me at different parts of the year. And I just don't find it intuitive. And I really appreciate anyone who can explain things clearly. And when I heard Bernie speak, I was really impressed, and I'm excited today to share some of Bernie's experience being an accountant for over 10 or so years, and she will help us demystify some of those tax topics that might also be not such a favourite topic to you. Let's, on that note, just before I throw to Bernie, let's see. So how do you feel about tax? So we're going to launch a little poll and have a think about how you feel about tax. Are you tax savvy? Do you have sort of a neutral, basic understanding? Or do you have quite a basic understanding and erring on, I hate tax time, which, as I have freely admitted, I would be towards that topic. So so votes coming in. So give us a bit of an idea about where we want to direct the conversation, and so please bring in your questions all along the way in the question box, and we'll make sure that we cover these topics as we go. So I'll close the poll and share the results. So 11% of people say, great, I'm tax savvy. 47% say they've got sort of a neutral basic understanding, and 42 join me with saying, tax really frustrates me and it's not my favorite. So that's interesting, and I'll throw to Bernie now, and really welcome and thank you, Bernie.
Thanks, Zoe, and thank you, ladies, for taking an hour out of your time. We do appreciate it. I actually am impressed because I thought that 47% would be much higher than that. It doesn't excite a lot of people, but it does me, so hopefully we'll get a bit of a takeout from this. I guess just to give you a bit of a background from me, I work in a regional town in Yarrawonga, which is in Victoria, and we've got about 47 staff, and it's a great mix. So we've got part-time and full-time, and mums that work from home and from the office, and flexible hours. So it's something we're really proud of. And I guess with 10,000 Girl, I was really excited to be invited to be part of this. It's a great thing to have women understanding their businesses or their home finances and where your goals and aspirations meet your finances. So it's great. I guess where my passion came from was really from my mum. She's one of my career role models, and she would be classified as never having worked. However, in perspective, my mum raised 12 children, 9 girls, 3 boys, and she now has 27 grandchildren. So she mixes a lot of personalities and gives out a lot of financial advice and finance from time to time. But she gave us 3 strategies: work hard, give back, enjoy life, and she says the rest will take its care of itself. So there's not too much I haven't been asked in the past, so please feel free to send your questions through to Zoe and we will address them. There's a lot of information to go through with tax, so I really encourage you for this to be interactive. So we might skip bits and pieces if people feel they're comfortable with it, and the comments that come through, and go through some bits in more detail. So we'll just look at what we're going to cover off on today. From the webinar, if we have a look, we talk about tax changes from the last financial year. We'll go through some of those common myths and mistakes that people make, and what you need to be aware of, and what you can and can't claim, and what you need to report and what you don't have to worry about reporting. The old question of do it yourself or need an accountant. As an accountant, I would say everyone needs an accountant, but not everyone necessarily wants to or has the desire to deal with their accountants, so we'll deal with that. Who is the right accountant for you? Where do you go for help? And then we'll just briefly touch on what might be coming up in the future and what affects all of us or some of us, and go through any questions. As I mentioned, as we go through, if you've got the questions, Zoe can fit them in when we can, or we'll address some of them later if we need to. So let's go back to the beginning and make a bit of a start. If we look at some of the changes from last year, there's changes in the way we claim our motor vehicle deductions. Not the fact that you can claim, so you still can claim and always have been able to if they're work related, but just how you go about that. There's changes to our medical expenses rebate that people used to be able to claim through their tax returns. There's a few changes to HELP, or as some of us would know it as HEX. There's changes to some of the thresholds in relation to your offsets that you can claim. There's some small business advantages that came through in last year's budget, and some offsets that you can claim, and there's also some changes to the small business company tax rate. So for those of you who might be in business yourselves and trading through a company, there's some advantages with that. So we'll cover off on these as we go through, and if there's anything you want to...
There's also a question that's come through that we might incorporate along the way as well, because I'm sure a few people fall into this boat that they might do a bit of freelancing on the side. So someone said, I'm a freelancer and I'm also employed by companies for short contracts. I'm confused how to do my taxes and would like to maximize my tax return, how to incorporate my expenses for my company in my taxes. So that's exactly what you sort of said, but I just wanted you to know that there is a few people in that boat.
That's great, and that's perfect, because that's what we want to cover off on, and just how that, so some of that will determine whether you actually can do it yourself or you need some extra advice. So we'll go through that in a bit more detail further on. So thanks for that question, because that's perfect. So back to the beginning, what makes up your tax return? So what do you need to look for? Your assessable income, it effectively can be broken down into 4 segments. Your assessable income, allowable deductions, any tax offsets that might be available to you, and other items. So your other items include things like Medicare levy and Medicare levy surcharge and HELP repayments and things like that. So we'll go through those in a bit more detail. Some we'll skip over because they don't affect the majority of us, but again, if it does affect you and we've passed by it, please send us through and I can send you some more information. We'll go through what records you need to keep and how long you actually need to keep records for. I had a client the other day who was going through his mum's house after she sadly passed away, and she had 45 years worth of records. You do not need to keep them that long, but seven years will just about round you off, I think. So we'll just have a touch on what you need to keep and for how long. So going through, if we start with your taxable income. So taxable income is broken down into various things, into your salary and wages, allowances, commissions and bonuses, lump sums, parental leave, and so on. So in terms of, from the question that was asked, your contracting income fits into this as well, really it fits into almost under the partnership and trust distributions. There should be almost another section which is private income. So it's business income that goes into that area there. So from the point of view of your salary and wages, they're nice and straightforward. You'll receive your PAYG summary or your group certificate, as a lot of people know them as, at the end of the year, and that will tell you what your income was. It will tell you how much tax is withheld from that and how you need to report it on your return. It is important to get this right. Some people forget to leave things off. The ATO can do a lot of data matching now, and there's a lot of information that they can collate from various areas. So from employers, they can collect from Centrelink, they can collect from banks. So they have a lot of that information, and it's your responsibility to make sure you're reporting it correctly. So we just need to be careful what to include. Depending on your situation with work, so if you've resigned from work or retired during the year or been made redundant from your position, you might have received some lump sum payments. So they include payment in lieu of notice. So if you are required to be given 4 weeks notice and your employer said, actually, you can finish today, we'll pay you out for the rest of your time, they'll have paid out a lump sum. They might have paid you some unused entitlements, so sick leave or annual leave, long service leave. Or if you were given a redundancy payment, they are treated a little bit different, but that will all be reported on your group certificate that you receive. So you should have all the information you need there to prepare your return for you. They are taxed at slightly different rates, but if we put them in the right boxes on your return, that will be calculated correctly. If you're in the position of receiving paid parental leave, either as a self-employer, you would have got it directly from the government. If you're an employer, your employer would have received that from the government and just continued to pay you. So there are ways that we need to report that, and there's a section in the return to do that. Dividends is a big one. So if you've got starting to get some share investments, and this also ties in with the question that came through earlier in terms of EFTs, so managed funds, shares, those sort of things, you'll receive a statement from either your dividend statements, which would have come out when you were paid, or you would have received a managed fund annual tax statement, which usually comes through about July or August. They will have all the details you need to include in your return, and it does come back later to claiming imputation credits, which we'll touch on a bit later. If you've earned interest from your bank accounts, if you've got a rental property, the rental income, the net rental income taking off your expenses needs to be reported, and capital gains. So we'll go through a bit more of that in detail. It's careful. You need to be careful. Sorry,
Yes,
Zoe, I missed that.
Oh, there's just a couple of questions that have come through that you can weave in now or later. Someone
Great.
said, does child support payments on the ex-husband count as income? And the other question is, in private industry, are you entitled to be paid out for sick leave when you leave your position?
Okay, so with the child support payments, that actually doesn't necessarily come in as taxable income. It becomes as an other assessable income, which we will touch on the next slide. So I might come back to that one. In terms of the other information, and sorry, Zoe, I just went a blank on that question, if you can repeat it for me.
That's okay, because it might be something that you have to actually ask your employer. But the question is, in private industry, are you entitled to be paid out for sick leave when you leave your position? And probably depending why and how you've left as well.
That's right, and it will depend very much on why and how you've left. If you resign for your position, the general rule is no. So if I come in tomorrow and say, okay, I'm finishing up, I'm legally entitled to my annual leave, which might have accrued my 4 weeks per year. I'm entitled to any long service leave, and that does change from state to state, so that's a little bit different. Your sick leave, however, doesn't get paid out on resigning. If it is as part of perhaps a redundancy, or there are some specific awards, so if you fit under a specific award that actually determines you are entitled to your sick leave, then there may be an exception to that rule. But generally speaking, if you resign from your position, no, sick leave doesn't get paid out. And if you are terminated, it doesn't generally get paid out either.
Great, thank you.
So if we then move on to your adjusted income, and this is where your child support payments will come in. So your adjusted income is your normal taxable income, so your assessable income less your deductions. It then adds back things like reportable fringe benefits, which again will be showing on your group certificate. The common one that I see for this is people who, particularly in the medical industry, where you can package a lot of things within your salary. Things like if you package a car, salary sacrifice a car through your overall package, your wage package, then that will come through. Reportable super contributions. So super contributions that are paid by your employer in excess of the 9.5%. So we're all legally entitled to 9.5% of our wages to be paid by our employer into super. If you're in a situation where you might have asked them to salary sacrifice or pay some extra money into super pre your tax calculations, then that actually will be reported on your group certificate as well, and that needs to be included in this section. There are some tax-free government pensions that need to be reported. Sorry, one thing I will make a comment to as well. With your reportable super contributions, this is one that employers, in small business employers that I deal with a lot, get really confused about how they've got to report it. So the first couple of years this came out, a lot of people were getting group certificates that had their 9.5% filled out on their group certificate, and we had to go back to their employer and say, no, it's actually only the extra money that they put into super. So if you get your group certificate or PAYG summary at the end of the year and you think it doesn't look quite right, go back and ask the question of your employer, because it is a confusing area for people. So don't be worried about asking that question. It's probably something they get asked commonly. The other one is your investment losses. So if you've got, say, a house that's negatively geared, and if you listen to any sort of budget or government reporting in the last 4 months, you're probably aware of what negative gearing is. Or if you have, say, shares that you've borrowed money to invest in, you might have losses from those that you report in your return. They need to be brought back to nil for this purpose. And your child support payments. So for the person who asked the question, if you are receiving payments from child support, or if you're paying out, so it's more the person who is paying the child support payments than the one receiving, you must report it in here. And what that does, if we just flick to the next slide, so what that does is it actually impacts on a lot of the different bits and pieces that get calculated as a result of your tax return. So it affects some of your tax offsets that you can claim. It affects private health insurance, which we'll touch on a little bit later. And tied in with that is your Medicare levy surcharge that has to be paid by some individuals. And these are the other things, government co-contributions. So when they look at these things, they will take your taxable income, they'll add these other items back and come with an assessable income which impacts on these. The important one for a lot of parents and families out there is your settling payments. So your family tax benefit, if you're receiving parenting payments, those sort of things come into here, and they are impacted by this. So it's just a matter of being aware of what we need to report to make sure we get our payments correct. So going on from that, if we just look at probably our common mistakes that we see coming through are people claiming their deductions incorrectly. So things like home office, self-education, and if you're paying expenses, say for like your phone or your internet, and you're using part of that at home, how you actually split that between what you can claim for work and what's actually private that you can't claim on your return. So we'll go through that in a bit more detail. The other thing we look at is the funny thing is with my mum, she got upset the other year because she didn't get a tax return. I said, Mum, you didn't actually pay any tax. So you can't actually get money back if you didn't pay tax. And that ties in a little bit with the bottom point there is if you don't actually get 100% of your deductible expenses back. So in your tax return, it's a pro rata of that based on your marginal rates. And we'll go through that in a bit more detail, but I think that is a common one that people get confused about. I'll just relay to you a memory of mine. I remember having coffee with one of my sisters and a few of her friends a few years back, and we were just sitting there having a chat, and she was telling them how it was June and she'd spent all this money on stuff for work for her employment, and because it was June it was perfect because she was going to get all of that money back in July. And I've sat there and didn't want to be rude, so I said, I don't think that's exactly correct. The response I got was, I've been doing my own tax a lot longer than you, I'm older than you. I don't think she realised I actually do people's tax for a living, so I kind of had a little bit of an idea what I was doing. But anyway, sometimes you are always the little sister, not the advisor. But it's just being aware of what you can claim to be aware of what you can't claim. So we'll go through the process of that a little bit later on. If we look at some of the common deductions, I guess, that are available to people going through that, that might explain it a little bit better for people. Great. So if we just go forward one, unless people have got general questions about that.
No, I agree with you. This might then give us specific examples so we understand. Because I have to say, we all, as small business people, we're always trying to claim as much as we can and probably jumping on the line a little.
And it is about bending it as far as you can, but not breaking it. It's the key to that. I hope no one from the tax office is listening to me at this stage. But most of our, so if we go through some of our common deductions for people, one of the main ones is work uniform and protective clothing. And this is one we get a lot of questions about, or a lot of invoices that come through and questions as to why we can't claim. So with your work uniform, if it's a specific work uniform, so it's got the logo on it or it's registered, then you can claim that. Or if it's something that's supplied by your employer and you're told you have to wear that for work, you definitely can claim that as an expense. Or if it's occupation specific, so when we talk about occupation specific, if you would use it for work, but you wouldn't use it really for personal use, e.g. if you're a chef and your chef pants and jacket that you wear to work, you're not generally going to wear them to the pub on a Saturday night. So they are specific to work. But where the confusion comes in is there's a bit of a grey area. Where does that actually cut off? If you can use it for personal use, or you do tend to use them for personal use, and it hasn't got a work logo on it, it's out. The other thing that comes through is protective clothing. So if you've got to wear protective clothing in your line of work, so it might be, say, the protective vests that people work, or some people need to wear fire-resistant clothing or non-slip shoes that are specific, say for nurses and things that have to have that, or steel-cap boots if they're working in a construction environment. Those sort of things are obviously all work-specific, so they're deductible. The other thing to think about is if your work requires you to be, say, out on the road, so if you travel a lot for work, or say you're a teacher and you're required to do yard duty or bus duty at the end of the day with the kids, things like that, you can claim things like your hat or sunglasses if they're of a protective nature specific to work. So there are a few things like that to keep in mind that you are able to claim. Things like your home office expenses.
Someone said, and yes, we did all read this recent article, I hear you could claim deductions for handbags now.
That would be great. If I could claim all my handbags, I would get nearly all my tax back, I think. It comes back to work-related items that you're required. So if you're required to take things home at the end of the day to work from home, or it's for a security reason, you might have to take things home. So if you're required to take the backup discs that all the records at work are taken on, or you have to take your laptop home, then you can claim your bag. I'm not sure that the beautiful Gucci clutch that you take out on a Saturday night might get through that. You do need to be able to put more than your lipstick in it to be able to claim it. But yes, if it is actually for work, or it's a nice, say, satchel, it basically ties in with the old briefcase that people used to be able to claim. Obviously not too many of us girls out there will take a briefcase to work anymore. But if you can tie it into needing to take it to work, you can put it through there. So, and it is a great article. We should maybe flick that around, Zoe, because I did like that article.
Yeah, we'll send it through. So someone said, I'm an entertainer. That means that the dresses for my performances are not covered if I do decide to wear them for events. And someone else has said, is there any price limitation? There are large, expensive bags out there.
There are some very large, expensive bags out there and some very nice ones. Again, the ATO doesn't actually put a specific price limit on it. However, if you got questioned and they do just randomly select people, you would need to justify that you A, have a receipt for that bag, and B, that it is for work specific purposes. So provided it actually can carry things and is practical. So a lot of our very nice handbags out there still wouldn't fit our laptops or our tablets in it. So wouldn't matter the price. But as long as you've got receipts and can justify it, yes, it's claimable. The one in relation to being an entertainer, it would be specific. You do need to be very careful about that, and it is worth getting specific advice about that. Generally, no. Generally, unfortunately, because we're in the environment, that a lot of it would be private. But if it is stuff that you are required to obviously dress a certain way because you're standing out in front of people all the time or things like that, there may be an element of it that you could claim, but perhaps not all of it.
Great, thank you.
Does that make it a bit clearer?
Yep, that's it, thank you. Oh, so someone else has a question. Are you able to claim business coaching as either A, an employee, or B, a small business owner on your tax return?
Great question. So this probably ties in a few points down. We've got self-education there. Really, in claiming your tax deductions, what the ATO says, it has to have what they say is a nexus or a connection to your income. So if you're incurring expenses that directly relate to the income that you earn, so as a professional, if you're required to do training or mentoring that actually improves your position, then it may fall under the self-education category and you may be able to claim it definitely. If you decided that, okay, so I'm an accountant at the moment and I decided actually I really want to be a nurse, I don't want to be an accountant anymore, and I went out and did a nursing course, that is not, the training for that is not specific to the work I currently complete, so I can't claim that because it's in relation to changing my career or changing my path. But if it is expenses for your work that you're doing now, and a lot of us do actually seek coaching or mentoring because that actually improves the position, and particularly if we're stepping from somewhere, either it be a small business or in an employee role, if you're looking to take that next step, so you've been, say, a trainee accountant and you're stepping up to a manager, definitely there's a lot of training that you need around that to make sure you fulfill that position. So there's certainly an argument that you can claim that if you can connect it back to your employment income, definitely. And with your self-education, it's things like that. It's doing additional courses that you can claim, and there's specific. So the first $250 of self-education you can't claim, so they exclude that. So if you've got a course, say for $1,000 that you pay to do, obviously the first $250 is taken off that. But also you need to look further at the self-education, and so I think if we flip forward a couple of slides, and we might come back if that's okay. I've actually got a slide on self-education there. Maybe. Here we go. So just to cover off on that, so it has to be in relation to your work, as we said, but look at the extra expenses that you have to spend. So don't just look at the course fee. If you're travelling from work to your place of training, or so you might have to go from the office to the place of training and then go home, you can claim that travel. You can claim stationery in relation to that. If your course is in Melbourne, for example, with the likes of myself, there's not too much training that gets done in Yarrawonga. A lot of us travel to Melbourne. So the accommodation of the travel down there is deductible. The cost of buying books or journals in relation to your work, those sort of things can come deductible. So make sure you look beyond what just those course fees and have a look and talk to someone about what is the extra things that you're incurring. And I touch on it a bit later, but my tip would be for people, keep all your receipts, because as an accountant or as an individual doing your own return at the end of the year, it's easier to go through and look at 10 receipts and say, actually, those last 5 you can't claim, than people, and we get it all the time, who come in and say, I did a course. Excellent. So what did you pay for it? Oh, I can't remember, but I did it and it was really good. That's great, but we can't claim that unless we've got something that can substantiate it. So you're better off to keep a lot more receipts and throw the ones out you don't need than to not have your paperwork there. It just makes life too hard for you at the end of the day.
Great tip.
So
Gotta go forward.
We might go back a couple if we can. So the next one is your home office expenses. Well, we might come back to home office because I've got a couple of slides on that. But the other basic ones, I guess, to remember are things like work registration. So your nurse's registration is an easy one. But if you have to pay an annual fee for the work that you do, or as a small business, if you've got to pay annual registrations, you might have societies that you register with. You might have books or subscriptions that are as a requirement of the industry that you're in, or even just to enhance the work you do for your clients or for your customers. That's all deductible. The cost of getting your tax return completed, that's deductible. And also if you travel to see your accountant. So any of you that want to come to Yarrawonga to see me, that's a tax deduction. But the other things are donations, and donations is one which people get a little bit confused on as well. Donations are deductible provided that they are paid to an approved organisation. So as a charitable organisation, you actually need to register with the tax office, and you have to fill out a lot of registrations that actually put you on an approved authority list, which is publicly listed. So people can access that, and it's payments to those. So your obvious ones are things like your Red Cross or the Blind Society and things like that you can claim. But you need to be careful that A, it's over $2 to get a tax deduction, and B, that sometimes if you get something in return, it actually becomes non-deductible. So for example, if you're buying raffle tickets, or if you go to, say, a silent auction, they may not necessarily be deductible because you're actually getting something in return for that. There are exemptions to that. So a few years ago we had bad floods in the area, and also with the bushfires, and there were a lot of fundraising going on, and they did make exemptions that people could claim that because it was such a specific cause. So it's just a matter of double checking before you claim anything, or on the flip side, double checking that you can claim it rather than just discounting it and saying you can't, because that's an important thing as well. Don't just assume you can't. Do the research and try and have a look for that. So the next big one, I guess, which is a common area that people get confused and make mistakes on, is on the next slide we look at home office expenses. So in the current environment that we're in, where you can log on to work in a lot of cases, or you're self-employed, so you're working from home and doing a lot of the office work, you can claim deductions for that. But there are traps and things you need to be aware of and be careful of. So as an employee, you can claim things like your running expenses, so your heating and cooling, electricity, gas bills, things like that, cleaning expenses. If you've got, you buy an office chair or a desk to put in the office at home, things like that can be claimed. And there are specific ways you can do it. So if you're at home, and particularly for those of us, I guess, that are in self-employed businesses, so the small businesses out there, but it works equally for employees. If you have a designated room in your house that is an office, so for example, with myself, I've got a 3-bedroom home. I have one room which is specifically my office at home. So it has my computer and it has everything set up. What we look at is saying, what is that percentage of the overall home that you can claim your expenses on? So if it works out, say, for example, say 20%, then you can claim 20% of those costs, so 20% of your electricity, 20% of the gas, things like that. Where it becomes a grey area is being careful that you don't overclaim. So you can't claim things like your rent or your utilities. Again, if it's a small business and specific, there are some exemptions to that, but as a general rule, as an employee, and I think I may have on the next slide put that, so perhaps, that so you can't claim occupancy costs, so your mortgage interest, council rates, insurance premiums, so you need to be really careful with that. The other thing is, even as a business, if you are able to claim, and this is really general information, by the way, so you need to speak to someone specifically about your situation, but if you claim your rates and your mortgage interest or a percentage of those, what it can do is mark up capital gains tax for you down the track. So at the moment, if you live in your own home and you own your own home or are paying it off, like a lot of us, if you sell that, it's tax-free. The sale proceeds from that has no tax implications. However, if you start claiming a lot of those deductions, you effectively are converting your home into partially business premises, which have tax implications down the track. So you might be getting a deduction now, but it might work against you in the future. So it's just be careful of things like that.
That's great, Bernie. And I know that it can get a bit like confusing, and there are different specific rules. So in this sort of case, that's where I know I value my accountant and getting some advice, especially if you're running a small business and you can claim quite a lot of things, but you don't necessarily know what exactly that is. There's another question about home office. Does university study count, or is it only for current employment?
No, so if a couple of years ago, actually, there was an interesting thing come out, and it was a case go through the tax office in relation to people claiming expenses if they were receiving youth allowance. So there's a bit of a grey area there. But if you're doing so sort of any sort of study, but in particular, if you're doing it in relation to work and you're studying at home, definitely there's some costs there that you can associate to that, because it's a cost of studying. I mean, obviously there are 90% of the courses you go to, there's follow-up that you need to do at home and then come back to uni or to the course that you're doing. So definitely you can look at that from that point of view.
And then one other home office question, how about if you're renting? I know you just specified if you're owning your own home. Are there any slight differences if you're renting and you've got a home office?
If you've got a home office, again, as an employee, the ATO does actually discount that. They don't really generally allow it. As a small business, if it's something specific that you can identify as clearly defined, so you don't use it for anything else, it is a bit of a grey area. You do need to be careful, and you need to be, in your specific case, have a look at that. So it is a grey area, but it may be claimable.
Great, thank you. We'll move on. We've got lots to cover and 15 or 16 minutes to go.
So the next ones won't take probably as much time, so we might slip through them a bit quicker. And if people want us to come back, definitely we can and move through those. So it's just being aware of, a lot of us now are working remotely or going from home to work and things like that. So things like your laptop or your tablet or your phone, and we all seem to have multiple things, hence our big handbags that we need to take. So those sort of things can become deductible if you're using them for work. So with your laptops, over a certain amount, so over generally over $300, you need to look at, as an individual employee, over 300, as a business that may extend up to 1,000 and beyond that at the moment under some specific provisions, but we'll come back to that. But generally, if you've got equipment that you have to use, you can depreciate those or claim them. Also things like, we had a client come to us recently, and part of their role at work was actually to take a lot of the photography for their website and for their monthly newsletter and things like that. So that actually bought a camera, and they bought a lot of equipment and SD cards and things that they need to use. That sort of equipment can be deductible. If you're using it, if you're buying it for work and using it, then you can claim that. Things like your phone bill, your internet, your software program. So if you're acquiring anything and it's specific for work, then definitely it's worth asking the question about it and having a look at it, because generally it will be deductible. Where you need to be careful is a lot of these we will use for work, but we will also use partially for private. So when we look at those sort of things, we just need to be careful that we're pro-rating it correctly, and making sure we've got that going through. So, and we'll touch on that a little bit later as to how we go about doing that.
So someone specifically asked, like hard drive and USB keys, they're probably included, are they not? And then someone's asked about work registration. If it isn't compulsory, can they still claim it?
Definitely. So with the hard drives and things, yes, if you're backing up information, so you're working from home, and particularly, you know, as I said, look, if you're doing, say, if you're taking photos and you're downloading them on your laptop and you're making sure you keep those for work, backing them up on a hard drive, they definitely can be deductible. No problem with those. So those sort of things can definitely go through. And again, provided they're connected with your work. So there has to always come back to that connection with the assessable income that you're reporting, be it business income or employee income. They need to go back to that. And sorry, what was the other one, Zoe?
Work registration. So if it's not compulsory, can it still be claimed?
Definitely. So if it's, yes. So for example, with myself, there's a lot of optional registrations that we take. So I join in various groups that actually have forums to give us explanation of information. So those sort of things are definitely deductible. And again, as long as it comes back to being in connection with your work,
connection to work.
That's the key to it. It always comes back to you have to connect it back. So the last
That's
one
probably
is
good to the to cars, hey?
Yeah. So with our cars. So you used to have 4 different ways of claiming it, and 2 of them weren't used that regularly. So the ATO simplified things for us, and from now on there's only 2 options. There's a cents per kilometre, so you can track in a diary or in a logbook the kilometres that you do for work. So if you get to work one day and you're required to go to a seminar or to a training session, you might have work kilometres involved in that. So you take your car. As long as you're keeping a record of those, you can claim a cents per kilometre rate up to 5,000 kilometres. It used to be, depending on the size of vehicle, depended on the cents per kilometre you could claim. So small vehicles might have been 60 cents and larger vehicles went up to 77 cents. They've now brought in, from 2016 onwards, it's just a set 66 cents per kilometre that everybody can claim. So there's no different rates anymore. So those of you who may have claimed it in the past, just be mindful of that when you're looking at that this year. The other way to look at it, and particularly if you're doing a lot of kilometres, and there's a lot of people out there that are doing a lot of kilometres for work in their own car, if you track your work kilometres for a 12-week period, and there's some really good online logbooks now, and this is one thing that my clients hate. I keep telling them they have to do it, and every year they don't like to keep a logbook. It's too hard, but it is a necessity if you want to claim more than your 5,000 kilometres. It's based on a percentage. So if you keep a logbook for 12 weeks and you work out that 50% of your travel is for work and 50% is personal, then you can claim 50% of all the expenses. So your registration, insurance, repairs and maintenance, fuel, all costs associated with your car, you can claim the business percentage of that. But again, you do need to make sure you've got your logbook in place. And I have had that questioned.
So someone said, hi, there's a really easy to use ATO app for your smartphone that can be used to capture travel and deductions. Highly recommended. Thank you, Jessica, for that tip. That's great. There's a few other questions come in. So what if you use FlexiCar or another car hire system? Can you use the invoices to calculate the kilometres, etc.? And if we're using public transport and taxi to go to appointments, work, auditions, etc., can we claim those?
Yes. So your public transport, again, if you're going from work to something that you're required to do for work, yep, you can still claim your travel because you might not in the cities, you may not be required to use your car. It's much easier to have public transport. So they still would be deductible. In terms of having, as long as you've got a clear record of how you've claimed your kilometres. So a lot of us use diaries or Excel sheets. The ATO app is quite a good one to use in terms of it's quite simple to use. So tracking it that way, as long as you have a clear record of the kilometres you've done for work, then you are able to use those other mechanisms to track it.
Great. So someone said a Mikey or Opal statement.
Again, with those ones, you just need to be a little bit careful because it may not be 100% deductible. So it comes back to that private use. So if on your MyKey, you top it up continuously, and that's, I apologise, I'll use that one because that's the one I'm familiar with. So if that's the case and you're topping it up, but you're travelling from home to work every day and doing the occasional trip on it for work, it's only the trip for work that you can claim. So home to work you can't claim, but if you're using those mechanisms to do work travel, then you're still able to claim some of that. And again, it comes back to ask the question, have the information now, because it's easier to take it out than try and add it in and not have the information there. And I know that can become a bit tedious, but it is important to have it. Just makes life a lot easier for everyone.
Great, thank you.
So, and again, this comes back to what we said before. So in most of these cases, you'll have some that will be both work-related and personal-related. So your home internet or your mobile phone, all of those sort of things, they might have, so you might use it for work when you get home, but also you might be checking your Facebook or looking at your emails or downloading movies, those sort of things. That portion of it's not deductible, so you need to actually keep a logbook of some sort of log that says you're using them for work purposes, even if it's just writing down, keeping a track in your diary that you did 3 hours from home one night because either you were studying or you're catching up on work, claiming it that way. As long as you can substantiate what you're doing, that is the business portion. So, it might be 10% or it might be 50%. It's still a deduction, but just be careful that you don't put 100% in because unless you're able to claim 100%.
Great.
Okay, so this is going back to my comment before in terms of if I spend $2,000, do I get $2,000 back? Unfortunately, no, you don't. But it is something I hear all the time. So how it works is based on your marginal tax rate, and depending on your level of income, your marginal tax rate will vary. So if, say, for example, you've got assessable income of $50,000, you've got $2,000 worth of deductions. They might be registrations or uniform or whatever it might be. It brings your income back to $48,000. The tax payable on that is $7,827. When your employer calculated the tax and withheld that from your wages, they would have based that on the $50,000. So your employer's calculated based on the fact that you have no deductions to claim. So they would have withheld $8,500. You get a refund of $720 back. So $720 as a percentage of $2,000 is about 36%. So in effect, for every dollar you spend, it depends on how much tax you pay. You get that percentage back. It would be nice to get 100% back, but it just doesn't quite work that way.
That's great. That's really clear. That's great.
So the only other couple of things that have changed over the last few years that I wanted to touch on, I am conscious we're getting low on time, so I'll go through these a little quickly. Some things you can't claim anymore. So you used to be able to claim a 20% rebate for your net medical expenses, so your expenses less anything you got back from private health or Medicare. They're actually phasing that out, and there's only specific disability claims that you can actually make from now on. So in 2015, you were able to claim it if you'd claimed it in a prior year, but now that's pretty much for, 80 or 90% of its medical expenses rebate is now out. And also one that causes a lot of confusion is several years ago, the ATO brought in that you could actually report the deductions for your children's school education in your tax return, and you would get a specific rebate for that. But the complexity of that and them tracking that through tax returns actually led to them saying, no, they stepped that back, and you no longer report that in your return. You actually get those payments from Human Services or from Centrelink directly, and they're on sort of a semi-annual to an annual basis, depending on your personal circumstances. So I haven't covered off on Centrelink because it's really a topic all on its own, but it's just something to be aware of when you're looking at your tax.
Great.
So the other couple of things just to touch on was your partner's income tax return. You do actually need to put that, and I know for a lot of our clients who have partners that are individual employees who want their tax done on the 2nd of July, and when I tell them we're not doing the business tax returns till September or October, they're like, we want our money back. You do need to include your partner's tax return because that affects some of these rebates that you can claim, and also the number of children that you have. The other big one that I get from people is your Medicare levy versus Medicare levy surcharge. So there's two elements to Medicare. Medicare levy is paid by the majority of us. Really, once your income goes over $31,000, most of us pay it unless you've got a specific exemption. Medicare levy surcharge is for people who go over a certain income threshold. And it used to be nice and easy. It really was effectively if you went over $80,000 as an individual or you went over $160,000 as a family in taxable income and you didn't have hospital cover, private health care, and that's the important thing, it has to be hospital cover as well as your ancillary, then you got Medicare, then you got charged an extra 1.5% tax for your Medicare. They now scale that a little bit. So I have put in a slide, but I'm not going to go through the detail of that. I can send out more information on that if people want that. The next one is your, so we can move forward. So that's great, thank you. The only other one is your HELP or the old HEX debt. So you used to get a discount if you paid in lump sums. That ceases from 1st of January 2017. From then on, you just pay it through your tax. Now, the important thing is, particularly if you're just starting out with work, when you fill out your form for your tax file number declaration and give it to your boss, you just need to tick the box that says you've actually got a HEX debt. Or for those of us that have gone back and done a uni course after we started, you might need to adjust it so you don't get a tax bill at the end. So just to be aware of that.
Great. So there's a few questions, but we might finish your presentation, Bernie, and then just be available for another 5 or 10 minutes and answer the questions.
Perfect.
If some of you have work commitments or something and you need to go, we will be sending out the recording and a heap of other resources. So that we'll still get to all of your questions, if not within the hour.
That'd be great. And on that note, if you do have to leave, thank you for your time. I have appreciated it. And if you send through anything to Zoe, I can follow that up with her if we need extra information. So please don't hesitate to ask. We've covered off on the medical expenses, so we probably don't need to touch on that again. We can probably keep moving through that, and also your Medicare. So the only other thing, particularly for those in small businesses, is those who trade through a small business entity, so your turnover is less than $2 million, which is the majority of us, your company tax rate, if you trade through a company, will reduce from 30% to 28.5%. They are talking about reducing that further in this year's budget, but that obviously hasn't come through with the election pending and things like that. The other thing that they recognised is there's a lot of small business owners out there that don't actually trade through a company. So what they allowed was a rebate up to an amount of $1,000, so it's a percentage rebate that you can claim back as part of a tax. So it's 5%, but it rebate up to a maximum of $1,000. Thing to be careful of is if you've got salary and wage, because I think there was a question earlier from someone who said they do some private contracting, but they also have salary and wage. So in your circumstance, what we need to do is work out what is your business income and the tax that relates to that as a percentage of your overall income, because that will affect the rebate you get back. So again, if you're in that situation, I would recommend you actually speak to an accountant to do your return, because you might be able to get more back than if you just did it yourself.
Great.
They're the main changes that have really come through. And a lot of these other ones we've kind of covered along the way. So keep your receipts. Ask questions. Don't be scared to ask questions. Accountants are very good at what they do, but equally, we go to other people because we're not strong in other areas. If I've got a medical question, I go to a nurse or I go to a doctor, and I'm not scared to ask those questions. Be the same with your accountant. Ask them the questions. They're used to that, and they actually are passionate about it. So they like to talk about it, despite 90% of us out there not wanting to talk about it. So be careful and write down your questions is another tip. Sometimes you'll get into a meeting and you walk away and you think, oh, I really wanted to ask that question. I completely forgot because I got caught up in the conversation. If you write it down before you go in, you can tick them off as you go through. So I just find that helpful for me. And remember, it doesn't matter whether you lodge personally or you lodge through a tax agent. And this comes back to how you choose your tax agent or your tax accountant. Your responsibility the responsibility is on you for how that information is presented to the tax office. So if you use the tax office portal and there's interest that isn't on that, the responsibility is for you to add that interest in or give it to your accountant. So just be really careful of that, to double check everything. And again, if you're getting someone else to produce your tax return for you, ask them the questions about it. If you're not 100% sure, ask the question.
Yeah, there's never any harm in asking questions, and over documentation is better than otherwise. I know I've learnt those few lessons along the way.
Definitely. So we've all had that hideous haircut that we tried to do ourselves that didn't work. Same with accounting. Don't go cheap. If you need the advice, get the advice. If you don't need the advice, and it's nice and simple, do it yourself, but be comfortable. And I think on the next one, so I've gone through a couple of points. Oh,
it'd be even interesting to see, like, who is currently using an accountant or doing your tax yourself. And I know there's a couple sort of online ways to do it. So there really is a majority who, sorry, votes are still coming in. And so there really is a majority who are using an accountant, which is great, but still a substantial amount of people doing it yourself. So whatever boat you're in, use all this information to make sure you're asking yourself and your accountant or any advisors around you to make sure you're ticking all these different boxes that Bernie's sharing with us.
So and that, I think, comes back to, it does very much depend on your individual circumstances. So if you don't have any investments, so you've just got salary and wage and a couple of simple deductions, it might be really easy to do it for yourself, and particularly if you know your way around a computer and the internet and things like that. There's absolutely no harm in doing it yourself, and it does save you some dollars. But it comes back to your comfort level. So if you're going to lodge something and be really worried you get it wrong and it's going to stress you, get the right advice on it. Or I would recommend, if you have any way associated with a small business or with a family business, so if your partner's in a family business that you somehow are connected with, or your parents or anything like that, I would recommend you get some external advice, just because you don't know what you don't know, and we're all the same in our own professions. We know our own profession really well, but you don't know outside of that sometimes. And if you worry about getting things wrong, or you worry about what you're missing out on, and your advisors will be able to help you or instruct you with that and give you some advice on that. So it really comes down to what you're comfortable with. Great. And that really depends on who your advisor is. And it doesn't matter whether it's your accountant or your financial planner or in relation to superannuation, anything financial. It comes back to comfort and trust. Do you feel comfortable? Do they make you feel comfortable when you ask the questions, that you can ask those questions and not feel silly about it? Or do they ask you the right questions? Do they show interest in your business or your profession? Do they show interest as to whether your superannuation is being paid for you correctly, or what's going to happen down the path? Do they work well with your other advisors? That's another critical thing. When you're in business, you need your advisors, and you will have multiple advisors. You'll have a solicitor. Some of you will have a financial planner. Some of you will have an accountant. They need to be able to talk to each other, because everything that they do affects the other person or affects you. So that's a critical one to me as well. price is definitely a factor. Don't pay more than you should, but it shouldn't be your driving factor. Sometimes the cheapest is cheap for a reason, and sometimes people are just too expensive and you don't get the actual value that you should be getting. So again, ask the question, why are you charging me what you're charging and what do I get back for it?
Great, great. So there's lots of other places to go.
Sorry, Zoe, go away. That's great.
There's lots of other places to go for help, isn't there? Like, I know the ATO has a new My Deductions tool or app, and so you might be interested in that. And we'll also send around the apps about the, tracking your and some different tips and stuff that might be relevant to a few of you. So yeah, stay tuned for this recording and some other resources. Bernie will quickly take us through some of the changes ahead, and then we'll go through some of the great questions that are coming through.
So just something to be aware of, and a lot of these will be really up in the air. Obviously, we're in election time at the moment, so there's a lot of media press out there. And just, again, a little bit of information can be dangerous, so make sure you're reading fully. If there's something that you think will relate to you, make sure you read all the articles about it, be really informed. But from the budget, what they're talking about is proposed is changes to paid parental leave. So at the moment, if you're an employee, you can get paid parental leave from your employer for some people, not for all. Like if you're in a government agency, a lot of them provide paid maternity leave. And then you could also claim the government 18 weeks maternity leave. They are talking about looking to make changes to that. We haven't got the specific regulations around that. There are changes about superannuation. So at the moment, if you're over 50 years of age, you can put 35,000 into super, and under up to 30,000. They're talking about changing that and bringing that amount back that you can put in and claim a deduction for. So probably watch this space. And a lot of the other superannuation changes are around taxing the money for your superannuation in your super fund in retirement phase. So we won't touch too much on that because it may or may change depending on who gets in July. The other one that's had a lot of press over the last couple of months is changes to negative gearing. The Liberal Party have said that they, at this stage, won't touch it. The Labor Party are keen to look at making some changes to negative gearing and also potentially changes to capital gains tax. So at the moment, if you have a share, say a portfolio of shares or managed funds, and you sell them and you make a gain, 50% of that is automatically discounted. They're talking about maybe changing that and making adjustments to that. So a lot of that is just watch this space and see who gets in July, and then where we go from there.
Great to be aware of. So next steps, as I said, that you will receive a resource sheet and the recording, and you'll also receive a promo code for the next round of the 6-week Money Makeover program that starts on the 20th of June. So let's go through some of the fabulous questions that you have, but I just want to just also acknowledge that we have this opportunity to answer all the questions and to share these resources because of our really generous partnerships that we have. And of course, like Bernie's put a huge amount of time in, and as a small business in a regional area, it's a really generous thing to do. So if you want to read or be in contact with Bernie, you can actually go to our website and you go to our little black book, and you can read a bit more about Bernie, and her contact details are there, and contact details of a whole lot of other financial planners and mortgage brokers, and so these people are people that really, really care about women in particular, but about like education on a really grassroots level, because I know that Bernie will agree with me that it actually makes like your accountant's job easier if we are better as consumers at documenting, you know, keeping our good records and stuff like that, and asking good questions and being on top of changes, etc. So, Bernie, thank you so much. And will I just run through a few of these questions, and then you can pick and choose, and maybe we can follow up with some conversation now and some email. We'll email some resources.
Sure.
So someone said, I have a self-care plan at work which includes being reimbursed for gym, massage, chiro, etc., but is capped. Can I claim the extra money spent on my tax return? So I might read
Generally,
that, and then we'll choose, because there's quite a few, and then we'll choose some themes maybe.
Yeah, that sounds great.
What if you spend more than $1,500 on medical bills post Medicare reclaim? Why do we need to include partner's income, please? Does my income affect my partner's child support payments, i.e. by nominating each other on your tax returns, are his child support payments based on our combined income or affected anyway? Do we need to pay tax for Centrelink payment? I am Canadian living in Australia for over 2 years. I need to do my taxes both in Australia and Canada. Do I need an accountant? I don't have a high income, and it would be a pity to lose all my tax return for accounting fees. Most of my income from one of my jobs is salary sacrifice, and so pays 15% tax. Why does this need to be reported on my return? Could we get a copy of this presentation? Yes, you'll be sent the recording. You said I can claim travel to see my tax agent to do my tax. I presume this would be the mileage on the car. Okay, so there's lots of different questions that have come in. Is anything tickle your fancy as a starting point?
There's probably a couple of really easy ones that we can cover. The travel to the account, yep, definitely it's on mileage, so it's no different from any other work-related travel, so that's on a cents per kilometre basis, so that's fine with that. And also probably from a overseas worker if you're working here, same rules apply for you in terms of lodging a tax return. So as long as you've got your Australian tax file number, you can still do it online if you're comfortable doing it rather than going to a tax agent, and just report it this way. So either way you get your tax back. So as long as you're lodging it through the Australian tax system in some mechanism, that's fine.
And the ATO website make it pretty, like, you can find a lot of information about that.
Definitely, and it's getting more and more user-friendly, the website, to get around, so definitely you can find information on there. So the other one, probably, the other lots I can probably group in two. So the first one in relation to salary sacrifice and the self-care package. So there was one about the self-care and the salary sacrifice. Mm-hmm. With the self-care, there's a lot of, particularly in the medical environment, there's a lot of, or healthcare I should say, advantages to being able to package that you don't potentially get in other work environments. If it is for personal expenses that you can package up through work, the excess of that is not necessarily deductible. So if the excess of that is in relation to private, so your gym memberships, things like that, if they're not connected directly to your work, it's more an advantage to be able to package it than being able to claim it outside. So if it's still of a private nature, no, unfortunately you can't claim it. And the other one in relation to the salary sacrifice, I assume because you're talking about a 15% tax rate, it's going into your super fund. The reason they report it is the same as some of these other reporting mechanisms that in relation to Centrelink and child support and your partner's income. These things get recorded not from a tax or a taxable position, but more for there are ATO payments that take them into account when you get some of your, so for your private health insurance rebates and things like that, they actually gross up your income from your taxable income by some of these things, because it's actually, you're not paying direct tax on it, but you are getting a benefit from your employer by doing it that way. So they add these back, and that was what we talked about in the slide about adjusted assessable income. So that will cover on that. The medical bills of $1,500. Unfortunately, medical rebates are out now. So anything in excess, the old $1,500 cap is now history, for want of a better term. It's actually out, so we can't actually claim rebates on our medical anymore unless they fall under that specific disability claim. And the last ones I'll touch on was the partner's income, child support, and Centrelink payments, and I'll sort of tie them all in together because it's in some ways connected because they're all through the human services and Centrelink. There are some of your Centrelink payments that are taxable payments, so you do need to be careful with that. So some of your partnering payments that you receive from Centrelink, some of the pensions that you receive from Centrelink are actually taxable income, so you do need to report them in your income tax return. And then that also ties in with the child support. Putting your partner's income in may affect your child support. It is a specific, depends whether there's a private agreement in place in terms of that. So child support is a really specific area, and I'm not going to touch on it too close because I'm not a specialist in that area, but there is potential where you can be impacted. Generally speaking, it's your partner's income, if they're paying the child support, that will be assessed. But you do need to be a little bit careful in terms of your family income and what gets reported from that point of view as to whether it does impact or not. But generally speaking, it's your partner's income that will be assessed, not yours.
Great.
So I think...
So someone said, or this comes from the same person actually, why do we need to include partner's income, and do we need to pay tax for Centrelink payments?
Okay, so with your partner's income, you need to include that because of some of this assessable income. So with things like your private health insurance rebate or Medicare levy surcharge, it is actually based on a family assessment. So it's so as an individual, you have a tax rate a cut-off rate that actually invokes that rule to kick in for you, and if you're in a family situation, then it's your family income, your combined family income, as opposed to your individual income that assesses that. So say, for example, with private health insurance rebate, if you as an individual earn $40,000 but your partner say earned $130,000, well then as a family group you're over that threshold, so it impacts on the private health insurance rebate you get back, or if you don't have private health insurance, the Medicare levy surcharge. Whereas if you both as a combined couple come under that surcharge level, it doesn't impact you. The same thing is because ATO data match with Centrelink, so when you lodge your tax return, the ATO has the ability to send that information to Centrelink for family tax benefit payments and parenting payments. They will look at your family income as opposed to your individual income to make those assessments. So that's why you need to put your partner's income in, because it does affect some of those other payments. Sometimes you do need to pay tax on your Centrelink. Yes. Depending on the Centrelink payment you get, paid parental leave is a good example of that. It is taxable income, so it does need to be reported and you do pay tax on that. But it does depend on the Centrelink payment you get. There are various ones, a lot of them, probably 90% of them, aren't reportable, but there are some that are.
That is fabulous, Bernie. I can't believe it. I read you out like 10 questions really quickly and you've absolutely nailed them. You must have a very clever brain. Well, I just want to say thank you very much, and there's a lot of thank yous and appreciations coming through in the notes. So just a huge amount of appreciation and gratitude for your time and insights and experience today. And yeah, we really appreciate it. So if there's anything final you would like to say, otherwise, yeah, just a massive big thank you from all of us.
Well, thank you. It has been a great opportunity. I hope people have got something out of it. And as I said, I'm more than happy to follow up if we need to. So I appreciate that we've run over time and people have stuck around. So thanks for doing that.
Perfect. Thanks, everyone. Thank you so much for joining us, and kudos to you for really putting the time aside to make sure that you're sort of paving your own financial way, and may it bring you a multitude of returns. So thank you and have a great week. Thank you very much, Bernie.